This is one of the most important slides I think I've ever doodled. I don't doodle much.
It's a great slide. I'm looking, I'm like, that's an awesome slide. I love that.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. With the US and nearly every other major G7 country engaging in historically high levels of deficit spending and increasingly struggling to service their massive sovereign debt balances, how does all this resolve? Is there a path to a manageable ending here? Or is a debt crisis, a currency crisis, or both inevitable at this point? In an attempt to answer these fiscally existential questions, we're fortunate to be joined today by two great macro minds, Luke Gromen of FFTT LLC and Darius Dale of 42 Macro. It's a true pleasure to host both of these gentlemen on this platform at the same time. Luke and Darius, thanks so much for joining us today.
Oh, it's a real pleasure, man. Thanks so much. You guys are two of my favorite people. I'm so grateful to be here. Anytime we can connect, it's a pleasure for me and a treasure for our audience. So let's have a great day today.
Likewise, I'm really excited to be here. I'll always love talking with both of you.
Appreciate it.
All right. Well, look, right back at you, brothers. And I got to tell you, you kind of set FinTwit on fire when I announced that you guys were going to be speaking together here. Now, a lot of folks are saying, "Oh, I can't wait to see these two debate." My suspicion is that you two are much more aligned than you differ on your outlooks, and so I'm thinking that this conversation will probably more of like a co-exploration of a lot of these topics as you build off of each other's points of view. Of course, if there are points of difference, be great to sort of understand where and why you guys might see things differently. But I have a feeling this is just going to be a really fun collegial experience, and I know the audience is just incredibly excited for it. So why don't we just start by jumping right into the heart of the matter here. I'm going to start with a broad question, which I'm famous for at the beginning of these things. Why don't I start with you, Luke, and then Darius, you can respond any way you like. Luke, what is your current assessment of America's fiscal situation?
Unsustainable.
I was like, oh boy.
No, it's unsustainable. It's and you know, unsustainable doesn't, you know, just because something is inevitable doesn't mean it's imminent, which is absolutely true. But one of the metrics I use to gauge imminence of issues is this metric of what I call true interest expense, or your interest plus your entitlement, current portion of entitlements, plus Veterans Affairs, which is another off-balance sheet liability sort of interest payment. And when you add those three things together and compare them to total tax receipts, you are right around 100%, maybe slightly over 100% of receipts. And the challenge is receipts are at all-time highs. Challenge number two is that going back 80 years, you can set your highest marginal tax rate wherever you want to set it. And it's ranged from, call it 27 or 30% to 80% plus. It hasn't mattered. You always get 19, maybe 20% of GDP in terms of receipts. And we're just about there. We're maybe a little short of 19% of GDP. So tax receipts are already at all-time highs. And we're already in a situation where our interest and interest-like obligations are already above tax receipts. And so we need to grow GDP to get out of this. And the challenges of doing that is any kind of growth is good. Nominal, real's preferred. Nominal's fine, but with debt as high as it is, if nominal is mainly driven by inflation, then you have a bond market that can get a little, what did Donald Trump call it earlier this year? Queasy, I think he said. It'll get a little queasy again. And you can quickly offset the gains you make from rising growth with rising interest expense and set off somewhat of a debt spiral. And I would say, lastly, further sort of complicating this whole thing is the U.S. tax receipts, which are at all-time highs, are very marginally sensitive to stock prices. So you can't do anything that knocks stock prices down a whole lot, and certainly you can't do something that keeps them there. Things like austerity or Doge, which has since failed in terms of a lot of its goals. And so you really we're in this situation where the problem is acute with true interest expense over 100% of receipts. It's acute. It isn't always acute. We saw in 2020 post COVID the way they got out. It was up to 120% then in true interest expense as a percent of receipts, and the way they did that was by goosing receipts. You do stimulus, you cap yields with QE. S&P rises by 50% year over year. Inflation peaks at 8%. And true interest expense fell from 120% down to about 87% of receipts. So the release valve is ultimately, in my view, has to be higher growth, higher inflation, some sort of financial repression, and we can talk more about that. But I think the key takeaway is that the true interest expense as a percent of receipts metric suggests we are again in sort of this acute phase of what I'll call a rolling crisis in Western sovereign debt.
Acute phase of Western sovereign debt. Okay. Darius, my friend, reaction, additions to that?
Yeah, 100%. I don't want to bore the audience, but I think there's going to be a lot of overlap in what Luke and I discussed today, and we're coming at it from two different angles, right? Mostly from the perspective of fiscal policy, but also from the perspective of the policy response to fiscal policy and how they ultimately impact asset markets. And I'll go back to what Luke said at the beginning, which is how he would characterize the U.S.'s fiscal situation, which is unsustainable. I think when we talk about fiscal policy, particularly fiscal policy of the dominant reserve currency at the time, I think it's very easy for investors to get lulled to sleep by words like unsustainable, because ultimately it implies that there's just this unlimited scope on the x-axis for us to continue on the same path, the same trajectory, and it won't be any real significant ramifications for investors and the economy as a whole on I guess I would say an investable time horizon for most investors. I think that's the wrong way to view unsustainable in this context. And for a variety of reasons. I liken this lurching into what we would consider to be unsustainable fiscal dominance, very similarly to thinking about the kind of life risk associated with being the father of a 1-year-old today. It's my son's first birthday, and he's been walking for, I would say 2 or 3 months now, really well, running around. And I would say once he started walking, you realize that like your little, risk matrix, your risk sheet, if you will, as a PM, it expands exponentially. Once they can start running around and getting themselves in all kinds of trouble, and I think that's kind of where we are from a fiscal policy perspective. Like once your child starts walking, we're not going to go back to crawling with a much smaller set of risks. Now the risks are acute, particularly in the context of some of the fourth turning style forces that are being levied upon the markets. We can unpack these forces as we progress throughout the conversation, but I would say the key takeaway from our perspective in terms of how we are viewing this risk is rampant income and wealth inequality are sort of the underlying root cause driver of this fourth turning. How the government has chosen to respond to it has been very, really since we catalyzed ourselves into the fourth turning with the GFC. And ultimately now fiscal policy is being used as a tool to quell the populist, demands of the general public. And ultimately, this force, this income and wealth inequality driven force domestically is meshing with external forces that are actually limiting the growth rate of this demand for U.S. Treasury securities. You have remilitarization in Europe, you have strategic decoupling in China, and then you have Japan's policy normalization. Those are three forces that are likely to, at the margins, reduce global demand for U.S. Treasury securities, while at the same time, the growth rate of the supply of those securities has accelerated markedly in recent years, running record non-war, non-recession budget deficits. And so when you get to this phase of the game from the perspective of being a sovereign, whether you're the reserve currency or not, and historically a lot of the data that we've studied over 100-year-plus cycles is generally speaking focused on the reserve currency at the time. When you get to this point in the process as a government, you only really have three choices. You can try to cut your way out, which tends to be very unsuccessful, especially in the context of populist demands from the voting public. You can try to grow your way out, as Luke talked about, which I think we're currently engaged in. And then ultimately, when the grow your way out phase of the program fails, they're going to try to print their way out. And there's all sorts of economic and social ramifications for that. But most notably, those ramifications are likely to come in the form of rampant asset price inflation and ultimately total war. So hopefully we can avoid the latter part of that and just help investors safely land the plane on the former.
Okay, so you just mentioned a lot of things there at the end that are kind of scary. And you and I have talked about in your appearances on this channel, Darius, you do look through the lens of the fourth turning, which has a lot of disruption. It's really the old status quo basically failing and then getting replaced by a new order. And there's a lot of oftentimes pain and disruption through that process. I do want to talk a little bit more about kind of what this all looks like when it comes to its inevitable end, maybe not imminent. Well, I want to actually take Luke's words there. I believe you guys think that this is inevitable, and I do want to talk with you guys about inevitably what that's going to look like and how society will experience that. But let's get to the inevitable doesn't necessarily mean imminent part. So, Darius, when I talked with you last, you had been very bullish last year. You started this year quite bearish. Were validated as the market, dropped 20% as we got our way to the Liberation Day surprise. Then when I talked with you, I think it was a month ago today, I think it was June 22nd, you said, hey, I'm back to being pretty bearish. I was pretty bullish again. And the markets are up 5% in just a month. I think we were just under 6,000 on the S&P now. We're at 6,300, basically the day that we're talking here. So you can still have sugar rush. You can have a nice ride potentially in the near term, even though the longer term fundamentals are perhaps quite scary in the way that you mentioned here. So maybe Darius will go back to you, and then Luke will go to you. Talk about the difference right now between your longer term outlook, which sounds pretty concerned, versus what you think is going to happen in the nearer term as the government tries to wrestle with okay, well, what are we going to do? Cut spending? Probably not. Let's try to grow our way out of this. Maybe that'll help. And if not, we can always fire the printing presses back up.
Yeah, 100%. Yeah, and I appreciate you you characterizing it like that. I think one of the things we've done really well this year is kind of benefit from the fact that we run systematic risk management overlays. It was easy to come in our view. I think it's pretty easy to come into the 2025 with the expectation that markets and the economy would struggle because from our perspective, it looks like President Trump and his administration got a very strong mandate from the American public to come in and usher in what we call paradigm B, which is try to cut your way out of the problem. This fiscal malaise. If you go to slide 36 from our most recent macro scouting report, monthly macro scouting report, to me this is one of the most kind of important images I've ever seen in my lifetime. I hope it's one of the most important images anyone's ever seen in their lifetime, because to me what it signaled is a confirmation of three things. One, people don't like crippling income and wealth inequality. Two, people don't like 40-year highs in inflation. And three, people don't like being crowded out to a historic degree. So ultimately, in our view, we thought the Trump administration was going to come in and try to essentially cut. That is negative for the economy and asset markets. But the other two solutions to this debt problem that is unsustainable, in our opinion, are actually very positive for the economy and asset markets. One is, girding us to real growth and a potential productivity boom, and which is likely to transpire at least over the next few years. Who's to say how long it'll last? The latter is a sort of an inflationary type growth, to Luke's point earlier, in terms of trying to print their way out. I think we're many years away, 3, 4, 5 to 10 years away from the inevitable print your way out of it. However, we do believe that we're still pretty early innings in what we call paradigm C, which is the choice to grow your way out of it. And so if you sort of look at how they're going to get that done, if you look at the one big ugly bill in terms of what's likely to happen from a deficit impact perspective, the tax cuts and incremental spending from the perspective of the Defense Department and the border security, they're all front loaded for the first 2 to 3 years, whereas all the savings are actually back end loaded if they ever get legislated into law, given the the political volatility that tends to be a commonplace in fourth turnings. So we're going to get peak positive fiscal impulse over the next couple of years, while at the same time, something we've been calling for the past couple of years, which is we're probably going to see meaningful regime change at the Federal Reserve. In the last fourth turning, the Federal Reserve was essentially a tool of the U.S. Treasury to help capitalize the Treasury bond market. Now, there's quite a few more extreme circumstances back then, as it relates to the total war that we were experiencing in World War II. But who's to say we're not headed on that path to begin with? We have the whole world, increasing their militarization, and once you buy the toys, you want to use them. I mean, I think we saw what happens when you buy the toys. You want to use them last month, and so I think we're on a path towards we're on a very much a fourth turning inspired path of bigger fiscal deficits over the long term. Maybe not in a direct line, because we're probably going to see some growth from the one big ugly bill. But over the long term, it's very unlikely that we achieve dramatic fiscal retrenchment as a function of trying to cut our way out of the problem from a tax cut perspective, or marginal reductions in spending relative to a baseline that is quite unsustainable and terrifying. But to me, I think one of the most important things we got to talk about today, and I'll shut up, is the regime change we're seeing in the Fed play out in real time. And this is exactly what you would expect as an investor in a forward turning. If obviously it's very unlikely that we see a very easy transition from how the Fed currently operates and who's currently in charge of the Fed to how the Fed is probably going to operate in the future and who's going to be in charge at that point. It's not going to be a straight line or a quick and easy, painless process. It'll probably involve the courts. It'll probably involve Congress. It'll probably involve another presidential administration. But what's ultimately going to happen, and where you need to have your mind focus as an investor, is we have the negative real interest rates are a necessary solution to this problem. Like you're not going to get out. We're not even going to pretend to get out of this problem unless we have persistently negative real interest rates. And so one chart, two lines, plots I'll show you are, this is the floor Fed funds rate here in the third panel at 310 basis points. So that's the minimum value on the overnight index swaps curve out through 2 years. So essentially, where does the market think the Fed funds rate is going to get to from a minimum perspective? And then if you subtract the 2-year TIPS break-even rate from that, it's at about 36 basis points. I think you can subtract another 75 to 100 basis points from this, which means you got to subtract another 75 to 100 basis points from the TIPS break from the real floor Fed funds rate. I think we're going to be persistently negative from a real floor Fed funds rate perspective at some point in the future for a durable period of time. And that's ultimately going to be one of the many potential solutions they're going to use to try to delever the public sector balance sheet. Because the reality is, if you don't delever the public sector balance sheet, we are headed for total war. That is pretty consistent across hundreds, if not thousands, of years of economic history.
Okay, well, a lot packed in there, and Luke, I am coming to you here. So one of the main things I just wanted to get out there for folks is, while you think this sort of ends in this sovereign debt crisis, it's not going to be a straight line down from here, right? Sometimes people hear that and say, okay, well then the world's going to hell in a handbasket, and I'm just going to climb in the bunker right now and sell all my stocks. I'm going to go short because the system's going to implode and whatnot. That may be an extremely dangerous thing to do because in the near term, especially given all of these anticipated policy responses that you're expecting, Darius, we may see goosed asset inflation. We may see some growth that actually does drive the economy incrementally here in the near term. And so you got to be very vigilant, and you've got to be very active in your investing from here. Just a single set it and forget it type of approach, probably highly unlikely to work here. So Luke, we'll head back to you here. I guess please respond to that in any way you like in terms of the difference between short-term and long-term here as an investor. And then perhaps we can get to your thoughts on the point that Darius raised there at the end, which is, it seems right now the Fed is going to undergo some change and perhaps some major change over the next couple of years. At a minimum, we're going to replace the Fed chair. But if you listen to Treasury Secretary Scott Bessent, he's really kind of raising questions about the role of the Fed and whether the Fed is actually currently structured correctly. Like there may potentially be some push to change how the Fed operates here as the president, eventually picks a successor to Powell. So, anyways, love to hear your thoughts on both those two things: short versus long term, and then anything about the Fed.
Sure. Yeah. So similar to, Darius, actually, we came into the year saying, hey, we want to be low over our skis and we're cautious and watching what they were trying to do, right? Plan A was going to be, we're gonna term out the debt. We're going to take pain. We're going to term out the debt. and we'll move stock investors into long-term treasuries. Yields will come down. We'll term out the debt, all while we're doging, and we'll get out of it. And I I think I talked with Darius earlier this year, and we both were kind of like like we'll take some of what they're smoking. It's not going to work. And so I think that was plan A, and plan A failed for pretty. It was not surprising that it failed. And so to me, our plan A all along had been, listen, you've got to get negative real interest rates. You have to devalue debt to GDP, devalue the dollar, goose nominal growth, and as plan A has failed, it's starting to look like they're moving to plan B, which looks like a lot like the plan A that we'd been saying, listen, no, this is actually what you should do. Had I been the perfect analyst, we harp repeatedly. One of our, alamos, if you will, for risk management, is once the Treasury market starts dysfunctioning, U.S. policymakers jump right in and they do whatever they have to do to inject liquidity and smooth things over. And so one of the things we watch is the Move Treasury Volatility Index. And when that thing gets over 130, you pretty much can, cover shorts and begin to go long, et cetera, or because they have very much conditioned markets that nothing will be allowed to create Treasury market dysfunction, to possibly risk a Treasury auction failure or something like that. And so, had I been the perfect analyst, in April, we had Liberation Day, April 2nd, April 7th, intraday, 7 trading days later, the Treasury Move Volatility Index hit 172 intraday. I mean, we were talking about levels seen like in the depths of Lehman. After not, just historic. And so, I wrote about it at the time, and I said, this is probably it. But had I been the perfect analyst, I would have just said, listen, don't grow a brain. They're not going to let the Treasury market break, buy everything. And that, and then not written anything for about another 2-3 months. Gone to the beach and had a drink. But at any rate, it was very clear that was momentous. And I think that was really where we started to pivot, was around that, to being more bullish. It didn't happen fast enough, objectively. But ultimately, where we sit today, we wrote a piece a couple weeks ago where I think in the second half of the year on net, we're very bullish for the, we think the markets will finish higher. And the reason we think that is number one, the dollar has already fallen by the most in 50 years in the first half. And that tends to be stimulative, and it tends to be good for liquidity, and it tends to be good for global growth on a lag. And so I suspect, all else equal, the biggest drop in the dollar in 50 years is probably, all else equal, it's a factor that will drive better than expected global growth and inflation and nominal growth in the back half of the year. So that's one thing. The second thing is this shift to plan B of more growth. We're starting to see the U.S. pursue outright industrial policy. When you marry that with some of the reindustrialization and remilitarization almost being discussed in Western allies, that too is probably good for nominal growth. I think that will ultimately be caught up with inflation, but there's this moment in time where you start doing these things and the growth looks good, and then the inflation catches up later. And I think we're in we'll be in the back half of this year. We'll still be in the growth looks good side of that. I think paradoxically, for at least the next 6 months, I think something really important happened at the end of June, which is peace was enforced on the world by China. Paradoxically, it was made obvious, is become increasingly obvious over the last 18 to 24 months to us that Russia was going to win in Ukraine. But in the last 12 to 18 months, it became very clear that Russia defeated NATO in Ukraine because it outproduced NATO in Ukraine. When we marry that with the inability of the U.S. to go to war with a near peer or peer power without Chinese rare earths and other Chinese supply chains, we saw something really interesting happen post-Liberation Day, which is the Chinese said, oh, okay, we're going to stop sending military-grade rare earths immediately. Have a good day. And I don't think they're ever going to resend those in any real way, because the Chinese aren't stupid. We can say a lot of things about the Chinese. One thing we can say is they're not stupid. And so when you have the U.S. Sort of chapter and verse across the administration saying, we need you to send us those military grade rare earth magnets. And the Chinese say, sure, why? Is it, oh, so we can build weapons to point them at you? Like, it doesn't take a genius to say, you know what, we're just going to slow roll this stuff. And the Chinese have 1,000 different ways to slow roll this stuff. And if you look at different company releases, if you look at the data, they are slow rolling it. And I think they're going to keep slow rolling it. And so, again, it's another one of these things where ultimately that creates two things. Number one, maybe, increases eventual tensions, and it certainly incentivizes industrial policy, which is growth driver. I think we saw that with this MP Materials investment by the Pentagon just 2 weeks ago. But for the next 6 months, nobody can go to war unless the Chinese say so. And peace is good for markets at a time when a lot of people were worried about war. And we also saw it not just in Ukraine, we saw it in Israel. Like after 11 days of heavy intensity, not even heavy, medium intensity combat, the U.S. had chewed through 15 to 20% of its anti-air defense missiles inventory. And it takes a long time to replenish that stuff. Israel complained about it as well, that they were running low on air defense missiles. So I think we have sort of, lower dollar, peace. And then the last thing is this, what to me, this stable coin, the real driver to the stable coin initiative is, it appears to me that Besant et al. Are attempting to engineer a sort of active treasury issuance program.
Right, a new buyer of treasuries, right?
Yeah, they need repressible balance sheet, and the way they're setting up stable coins, to my eyes, is setting up globally repressible balance sheet. And so when I marry lower dollar, lagged effects and benefits of that, peace, industrial policy, and active treasury issuance through stable coins, to me, it's a pretty bullish setup still. Now, my one caveat is over the next, when I wrote this 2 weeks ago, over the next month or two, we expect to see a period over the next month or two of heightened volatility around the bond market. Basically, I've got one eye on what Japanese bond yields are doing, what UK bond yields are doing, and what they're doing is not good for U.S. markets, U.S. treasuries, because ultimately it's going to put upward pressure on long end of the U.S. curve. And so I think ultimately the four factors I highlighted before will win out over the net course of the second half of this year. But I'm a little cautious in sort of the next month or two around just around markets, not outright bearish or anything, but just I think this volatility we've seen, in 10-year yields going up in Japan, in the UK, the US, we've had some pretty tame inflation numbers, and the 10-year yield won't go down. And we're not, we're 2 or 3 bad days in the 10-year market from being into that range again where it starts to be problematic, which I think is 4.6%, 4.8%. You start seeing, yields at those levels for the U.S. start to weigh on stock market and stuff. But I think ultimately the 4 prior factors will win out because they give our policymakers some levers to play with as those levers mature. So,
okay.
Sorry, the last question I would say, you said the Fed pressure. I'll follow up with the Fed pressure.
Right.
I think the Fed pressure is a symptom of exactly what Darius described. Like, why is the administration beating on Powell? Occam's razor is because they have to. They don't have the budget space. We are moving in. That's where, there's always kind of different symptoms of that true interest expense number that I talked about at the start relative to receipts. With each sort of iteration. And I think one of the iterations this go around is, Powell is being subjected to unprecedented political pressure from the White House and sort of the entire administration because I think they're desperate. They need to get interest expense down because the deficit is so big. And the true interest expense is so big relative to the tax receipts they're generating.
All right. Super quick question for you, then back to you, Darius. There was been a lot of drama of late that Trump might replace Powell before the end of Powell's term. Do you think that's likely or not?
I don't know.
Doesn't matter.
Yeah, I don't know that it matters. I mean, I think if you just kind of, that's a great way of phrasing it. I don't have any insight one way or another, but Darius, I think you're dead on, which is if they just badmouth him 24/7, you erode his credibility. It's sort of the shadow Fed, we all thought, we all thought, I don't know about we all, I shouldn't speak for everybody. I kind of thought of a shadow Fed as sort of this official second body of, that just is sort of guiding investors. But I was probably foolish or naive to think that's what it would look like under Trump, right? Trump is Trump. Love him or hate him. How it's going to look is sort of, all caps tweets calling him too late and all this, this sort of, Benny Hill show music, right? Around, he's a clown, right? So, and it's Trump's way of doing it, but it's kind of working. So I don't know if they will. But I would completely agree with Darius. I don't think it matters. I think they're going to do what they got to do to sort of undermine him.
Let me ask you a quick question on that. Then, so I agree. Pulling him now this late in the game, it's not going to really make that big of a difference. And Darius, I'm guessing maybe that's what you meant. If not, you can clarify. But to me, I agree. It's like pulling a bad quarterback at the end of the fourth quarter. It's like you should have pulled him like in the middle of the game, right, at halftime. But I do think it could really matter in the sense that, let's say Trump replaced Powell outright. Why would anybody listen to the Fed again? If Trump proves that the president can just remove the Fed chair at a whim anymore, why wouldn't you just listen to the president? He's basically setting policy in that case. So
yeah, I think that's partially why we're probably not going to see him removed. I think they're trying to walk a very fine line between maintaining central bank independence to keep a lid on long-term interest rates and term premia in the bond market, while also trying to guide markets to the ultimate policy outcome, which in our view, and I think Luke definitely agrees, which is we're going to have structurally negative real interest rates on the short end of the Treasury curve. And to complement that policy, and sorry if I'll stop, I don't want to cut you off, Luke, but to complement that policy of structurally negative short rates is the fact that we're probably going to see bill issuance spike. Right now, if you look at T-bills as a share of total marketable Treasury securities, it's about 20%. If you look at the share of Treasuries that are maturing in the next 12 months, it's about 31%. You can go back to about 35% in the former ratio and back up to 48% as far back as we have the data in the latter ratio. And by the way, I got to imagine it was much higher than that. We were in the last four turning in the 1940s and 50s. So to Luke's point, we're moving into this era of less Fed independence. The Fed will still be an independent organization, and I think it'll be very smart, a wise choice by the Trump administration to leave Powell and just continue to pinata him. But ultimately, we're moving in the direction of less Fed independence because we ultimately have this fiscal dominant situation that the Federal Reserve needs to support. Don't forget, the Federal Reserve is not this thing that comes from Mars or holy heavens to sit separate and apart from the U.S. political system. We created the Fed out of a political crisis, and it's going to continue to evolve to suit the demands of the U.S. populace, the U.S. electorate, and ultimately, in our view, that's headed towards a more printy, inflationary style outcome over the long term. It's not going to be, again, it's not a straight line, but from the perspective of investors operating financial market risk, you have to assume that if you take a multi-year investment horizon, that we're probably going to have accelerated monetary debasement and financial repression relative to what we've already experienced here in this fourth turning, since the GFC. It's going to get bigger because it has to get bigger to support fiscal dominance in an era where the rest of the world is capitalizing our bond market less and less at the margins.
All right, you're taking it exactly where I want to go. So let me ask you, hopefully a quick question, even though I know we could talk about it forever.
When has anyone ever asked me a quick question?
Yeah, I've got a quick question, a longer question. I'll ask them both, and then hopefully you can just answer them all together. One is, so Luke has said that his outlook is fairly bullish for the second half of this year for the reasons that he listed for us. As I mentioned the last time you and I talked a month ago, your model was still quite bullish. I'm curious, the short question is it still? Is it still, or maybe even better, what is your short-term market outlook given what your model is telling you now? And then secondly, the larger question, which I'll then come back to you, Luke, to give you a chance to answer, is Given what you just said about what you think is more or less inevitable to happen from here, Darius, what are the key investment themes that from a long-term standpoint that come out of that long-term view?
Yeah, 100%. I appreciate you asking. So, just give it a little bit of background so I can kind of explain our investment process because it is a little bit unique relative to I think most investors. It's more buy-sidey, if you will. We have fundamental research views, and then we have our quantitative risk management process that guides all of our investments. If we're right at predicting the economy and policy, then the quantitative risk management signaling will just evolve in how we communicate. But the reason we anchor our investment process on the quantitative risk management side is because when there are errors in our fundamental research process, we find those errors and correct them in our portfolios much faster looking at quantitative risk management signaling much faster than we would if we were just reacting to changes in data, changes in policy guidance, and ultimately our own emotional weddedness to our own pre-legacy research views. It just speeds up the process of recognizing mistakes and correcting that from a portfolio risk management perspective. And so,
and sorry to interrupt, but in a nutshell, you actively invest based upon what the quantitative model is telling
correct.
you. You have all that background.
Quantitative models. We talked about our KISS process in our
Yep.
in all of our episodes. I don't want to spend too much time on that. Investors can go look at our previous discussions to learn more about KISS and Dr. Mo. But just giving the reason I brought this up, this sort of dichotomy up is because we've been fundamentally bullish since I want to say the third week of April. We recognize that paradigm C, the pivot from paradigm C, which we identified alongside you, Luke, back on April 9th, was the day we noticed the bond market starting to blow up. And ultimately, that was the pivot. We got a few hours later. The bond market blew up overnight, and Trump pivoted. I want to say at 8 or 9 o'clock that morning in Eastern time. That, in our opinion, was probably the biggest catalyst we've seen in global financial markets since Lehman Brothers went bankrupt.
Wow.
And ironically, brought up Lehman Brothers in terms of the MOVE index, getting back to that level. In our opinion, that forced the administration to pivot from paradigm B, which is cut your way out of the problem, to paradigm C, which is grow your way out of the problem. Paradigm A being the problem that made the electoral college map look the way it did. Paradigm B is, okay, let's try to cut. Now they pivoted to paradigm C. And the reason we've been so resoundingly bullish from a fundamental standpoint since then, and ultimately our quantitative models have been so bullish and fully invested since early May, is in our opinion, I think we're insulated as investors because we're not going back to paradigm B. And here's why. If you look at the U.S.'s net international investment deficit, we're now at $26 trillion. It's 90% of U.S. GDP, almost a quarter of global GDP. It's more than doubled in the last 5 years. That was the risk that we saw on April 9th, which is, okay, this sell America trade, this bleeding out of our net international investment deficit could cause a durable loss of U.S. exceptionalism and ultimately a debt spiral. If you look at U.S. interest payments as a percent of GDP, we're now back up at 4%. That's a 3 sigma move relative to the trailing 25 years. And the reason we bring that up is because the U.S. is running this 12% twin deficit. We got ourselves a 6% budget deficit, record non-war, non-recession budget deficit. We have ourselves a current account deficit that's just bordering, just over just under 5% of GDP. So we're getting close to 12%. Yet we're capitalizing ourselves like we're a creditor economy. We're the world's largest net international investment deficit economy by like a factor of 10, if not 20. And we're capitalizing ourselves like we have all the money in terms of the valuation of our stock and bond markets. These lines show the mean of the 10-year nominal Treasury yield and MSCI index earnings yield, stock index earnings yield for all these different economies. And, at 4%, we're right in line with Japan, which is one of the world's 3 largest international investment surplus economies. And then we're below the capitalization rate of Europe and China, which they are the world's 2 and 3 world's largest net international investment surplus economies. So we're so ridiculously overvalued from the perspective of our stock and bond markets relative to how other net international investment deficit economies tend to get capitalized, how other twin deficit economies tend to get capitalized. If you look at India, Brazil, the UK, they're hundreds of basis points higher than ours. So the risk of staying the course with paradigm B, in our opinion, would have been a potential durable loss of U.S. exceptionalism because we ultimately would have seen these capital outflows from this net international investments deficit situation start to reverse and make our stock and bond markets incredibly poorly capitalized. That's why we saw several instances of the sell America trade in April. So in our opinion, Donald Trump is many things, but he's definitely someone who likes to be popular. We're not going back there and risking a durable loss of U.S. exceptionalism and ultimately the debt spiral that would associate with that, because you're talking about dollar down, interest rates higher, and that those two factors there increase the cost of hedging for U.S. dollars from the perspective of international bond investors. Right now, the cross currency basis is over 1% negative if you think about it from the perspective of Europe and Japan. So you're basically, that cycle, that reflexive cycle, would have sent a signal to every investor in the world to stop investing in America on a durable basis, and we cannot risk that outcome. And so this is why we've been so fundamentally bullish and resoundingly bullish. I don't think there's been a non-perma bull on Wall Street that's been more bullish than Darius Dell since May 3rd. And the reason for that is because I know we're not going back to paradigm B. So all the volatility that we may even experience over the next few months related to Section 232 tariffs, we saw a little bit, a tiny bit of volatility associated with congressional brinksmanship, but not as much as we initially thought. All that stuff we've been calling since May 3rd. These are all scarecrows that are designed to trick investors and prevent them from being, fully invested and trying to. It's almost like an illusion. It's like a magic show. Those things are scarecrows. What you have to focus on the forest and not the trees. And to borrow Luke's, I think that's a beautiful name for your company, because that's exactly what's happening. The forest is, we're in paradigm C. They don't have a choice but to try to grow their way out of it in paradigm C. They're going to try to grow their way out of it in paradigm C. Turn off Truth Social and President Trump's tariff tweets. He's not going to crash the economy and take us back to paradigm B. And so you have to assume that any volatility we experience along the way has to be bought, and it will be bought by the cohort of investors that is yet to, fully appreciate the breadth and the scope of paradigm C. I mean, a lot of investors are still worried about tariffs and whether or not, there's so much myopia now in this fire Powell situation. But the reality is, these are all things, as we started this conversation, these are all things you have to expect as an investor in a forward turning. Fiscal dominance. The monetary response to fiscal dominance is always financial oppression and monetization. And the fiscal response to populism in the economy is either grow your way out of it or print your way out of it. They're going to do both. It's just a matter of time as an investor in terms of, identifying those mile markers of we're transitioning from one paradigm to the next. And so that's what we got to do our jobs.
Okay. Maybe using that framework, and then Luke, I'm going to come back to you in just a second. So if we're now in the grow your way out of it phase, obviously you think that's going to be bullish for stocks. What investment themes surface there for you, right? Is it all the big build out beneficiaries, right? Is it, the hyperscalers and the, energy companies as we rebuild the domestic grid and drill baby drill and all that stuff, or is it something else? And then as we get to the print phase, and through all this, there's going to be an increased reliance on things like negative real interest rates and stuff like that. In that longer term arc, what other themes pop up? I might guess that things like gold and Bitcoin would be good for that. And I know your model invests in them because those are things that basically reflect the currency purchasing power devaluation that you get from the printer way out of this thing. So don't want to put words in your mouth, but what stands out in the grow phase, then what stands out in the print phase?
You asking me or do?
I'm asking you, and then I'm going to let Luke respond.
Oh, absolutely. So I'll be quick. We oriented the solution that we've developed for retail investors to help them retire on time and comfortably, particularly as it relates to finishing the next 5 to 10 years of this forward turning poly crisis. Our systematic KISS portfolio construction process puts you in the 3 asset classes that are most designed to take advantage of these dynamics. Stocks, that's they'll benefit from both paradigm B and paradigm D, which is grow and print. But Bitcoin and gold will obviously, have most of their asymptotic performance come in paradigm D. Doesn't mean that they won't benefit well from paradigm C, but the reality is you need to be exposed to all 3 of these factors in your portfolio if you want to outperform in a forward turning poly crisis. You don't want to be overloaded on nominal bonds and short-term cash instruments in an era where we're about to go to deeply negative and persistent real interest rates. Both the fiscal authority and monetary authority are pushing you further out on the risk spectrum. So if you stay, insulated, short in, if you say, kind of narrow in terms of the risk you're taking in your portfolio, that's fine. But the reality is, I think in terms of getting paid back on a real basis, to borrow one of the things that Luke's been talking about for years, it's if you want to get paid back on a real basis, you can't be in, what are quote unquote traditionally safe assets in the context of paradigm B or paradigm C, which is grow your way out, and the eventual transition to paradigm D. And the reason I bring up these two slides, is this is one of the most important slides I think I've ever doodled. I don't doodle much.
It's a great slide. I'm looking, I'm like, that's an awesome slide. I love that.
Yeah, so we did this big deep dive empirical study on fourth turning polycrisis dynamics to help investors understand, okay, what types of dynamics should you expect in the economy? What should you expect from the perspective of fiscal policy? What should you expect from the perspective of monetary policy? And ultimately, what should you expect from the perspective of geopolitics, which is how the countries interact with each other? And sort of there's a lot of key takeaways from that investing during a fourth turning regime presentation, which is available to all of our clients in our dashboard. But if one of the key takeaways from that presentation is actually in fourth turnings, we tend to have a faster pace of asset price appreciation than normal, which is kind of counterintuitive if you think about, okay, we have society being ripped apart at the seams by inequality and geopolitics fraying at the margins and going from a unipolar to multipolar world and the potential for total war. This stuff all sounds incredibly bearish, but the reality is empirically, when you study these fourth turning regimes historically, we've seen faster asset price appreciation, but we've also seen more volatility along the way. And so ultimately, the market cycles themselves get faster from a frequency perspective, and they get more exaggerated from an amplitude perspective. And so you need institutional grade risk management to survive a fourth turning polycrisis with your portfolio intact, let alone at a much higher net asset value than you entered the fourth turning polycrisis. If you sit there as a retail investor and you're going to try to paper trade your way through this, I promise you it's not going to end well. So in my opinion, we built I left sort of traditional Wall Street to build this company to help regular investors to add, institutional grade risk management overlays to their portfolios so that they, among other things, can take advantage of these fourth turning polycrisis dynamics by being in the right asset classes. And so that's kind of why I wanted to end on this slide with my commentary, which is, we're all frogs being boiled alive in a pot full of monetary debasement and financial repression. These are two things that you have to expect will get bigger over time as a function of the fiscal dominance regime, which itself is a function of the fourth turning, internal and external political strife dynamics. And so ultimately, you need these risk management overlays to stay in the right assets to actually benefit from these forces, but also risk manage these very aggressive, higher frequency crashes along the way. I want to say the market has crashed 4 times since 2018. It had crashed 4 times in the prior 2 decades. So think about exactly what I've been talking about. The frequency of these and the severity of these drawdowns is increasing, but at the same time, we're actually experiencing much more upside from the perspective of asset markets, like 2 consecutive 20% plus years. I got to imagine we might be up 20% again this year in the context of paradigm C and everything Luke's talking about. So, there's a very positive outcome from a long-term portfolio risk management perspective, but it's not going to be easy to collect the beta that you need to collect as a retail investor to retire on time and comfortably without institutional grade risk management overlays, in my opinion.
All right, makes total sense. So what I interpret from that, just boiling it down, Darius, is you need to know what assets to be exposed to given this regime, and then you need to know how to be exposed to them along the way, because it's going to be changing quite quickly. Or
can I say one quick thing? Reduce the number of bets that you're making in your portfolios. You don't need to be this sector, that sector, this factor, that factor, this country. You need to be long stocks, gold, and Bitcoin if you want to survive a fourth turning with your portfolio at a much higher net asset value than you entered it with. Every other decision you make as an investor trying to play captain hedge fund manager and picking factors, that's all stuff that's going to erode your performance relative to the market performance, which is increasing at a faster rate.
Great. And obviously that's how you've constructed the KISS model. Keep it simple and systematic. It is very, very simple, but very, very effective in its track record. And I am trying to kind of give a soft promotion here to both of you guys here, which is for the average retail investor here, you have to know what to be in, but you also need to know how to be in it, given what's going on, with real-time developments on the ground. And your doodles, I think, did a really good job of demonstrating that. All right, Luke, so coming to you. So that's Darius's point of view here. How does yours overlap, differ, et cetera, with that?
It's interesting. I'll tie back the frog in the pot, I think, is a great picture, because if I put a tinfoil hat on for a second, one could graciously look at the tensions between Bessent and the administration as again, this isn't my base case, but I want to be open to the possibility that it's sort of wrestling kayfabe, right? Because ultimately, part of the trick of negative real rates and running a successful negative real rate regime is to keep the keep the long end from running away from you, right? Keep the long end long end of the bond market frog in the pot.
Mm-hmm.
And so, in theory, one way, if someone came to me and said, "Luke, how can we do this?" I could think of a lot worse ways than getting a soap opera, going between Trump and Bessent and Pulte and Vance and Powell, where Powell's like, look, eventually I'll give you what you want, but what you're doing, we got to watch the long end. Here's what we're going to do. You do negative real rates and start doing your industrial policy and just beat on me. And I'm going to stand in like Paul Volcker, and the bond guys will also go, oh, see, they're not firing the Fed. They're not. Now, they're getting boiled all the same on
Mm-hmm.
a real basis. But, it's not lost on me that it was reported not that long ago that Bessent and Powell meet regularly. I don't know if they still do, but if someone knows out there that they still do, that would be really important piece of information, I think, because it would
He has
suggest.
said that, just so you know, he has said recently of late that they still have their weekly breakfasts.
Yeah, it does make like it's a way that I would keep the frog in the pot if I was them. But at any rate, I agree with how Darius laid that out. I think ultimately Western investors broadly, but American investors in particular, on average, have they don't have the personal historical experience of when things get really crazy, the price of everything goes up, not down.
Mm-hmm.
And we've started to see that, particularly when married with the net international investment position dynamics that Darius laid out. That's something that we've harped on a lot for a long time too, which is world long, whatever, $26 trillion net in dollar assets, and they've borrowed $13 trillion plus in dollar denominated debt. And so anytime the dollar gets too strong, they're just going to sell U.S. assets, and starting with U.S. Treasuries, it's the deepest, most liquid market in the world, to raise dollars. And they will keep doing that until the Treasury market dysfunctions. And then, we've had kind of this repeated, and I think that is the underlying dynamic that has been driving these drawdowns and the responses and that volatility. But then we go back to what I called my Alamo, which is they're not going to let the Treasury market dysfunction. And if that, as long as that remains true, then ultimately, I love that chart of the higher amplitude and the greater frequency of the higher amplitude within the broader context of, stocks are going to rise rapidly or stocks are going to rise fast. Treasury market's ultimately going to kind of be, what a good friend of mine calls blood sport, where you want to trade it back and forth, great, but they're going to do whatever they got to do to keep 10-year yields between, 4 and 4.5, maybe 3.5 and 4.5, something. I don't know. And you want to trade that, great. But as as you're looking to pick up nickels in front of steamrollers in terms of trading the 10-year well, S&P has to go up a lot every year over time to make the math work. Gold is going to go up a lot for multiple, or not just here, but then also, around the world geopolitically, you cannot store the wealth of a nation as an FX reserve manager in confetti paper, right? You can't put your national wealth reserves into assets that the issuer has to debase just to be able to pay you back nominally. And so I think one of the big misperceptions for this cycle is that, 1,000-ton per year central bank buying. Well, that's just because of Russian sanctions. If we get peace, that'll go away. I don't think that's going away I think central banks will be buying 1,000 tons of gold every year plus for years and years to come. And I think it's very bullish for things like gold. Who knows? Maybe they'll start to look into Bitcoin as an official basis. But I think ultimately, when you talk about things like the U.S. needing to implement stable coins and the Genius Act to sort of make the math work and create more front end demand to shift to the front end to keep hold of the long end, there's a pretty good correlation between, the more stable coins you create, the higher Bitcoin goes in price over time on high volatility. And then you get into some of the more fundamental things of we don't have the grid we need to, and we need more. I mean, there was a great chart that Leopold Aschenbrenner put in his AI report last year. I think it was called Situational Awareness. And it showed that the Chinese electrical grid is now, the Chinese electrical capacity is now fully double ours. And that is insulting enough, but it's really the real injury to the insult is that the United States electrical capacity really hasn't grown at all, at least prior to 2021, since 2004 or 2005. So basically, we spent, from 2000 to 2022, we spent $31 trillion in debt, and we didn't grow our electrical capacity at all. And so what this Aschenbrenner chart shows is that, people say, well, we have the technology, we're still ahead of China in AI. And that is probably true. I have no reason to refute that. But that's not where the bottleneck is. The bottleneck is not there or in our ability. Our bottleneck is we literally don't have the grid. This Aschenbrenner chart shows if AI consumption and hyperscaler consumption keeps growing, it'll be 100%. Global hyperscaler production will be 100% of our entire electrical grid by 2030, 2029. So we are doing things that might not be in our long-term interest, but we have to do, like offshoring AI to the UAE and Saudi, and these deals we did a couple of months ago, and which are always spun as for our highest and best. Maybe for our highest and best, so that we don't run out of electricity in 12 months and have rolling brownouts in the U.S. Long-term highest and best, who knows? But I think ultimately, when you see these capacity constraints, and in the context of this fourth turning urgency and geopolitical tension, to me, it further reinforces gotta have negative real interest rates, gonna have negative real interest rates, and sort of Manhattan Project-like urgency to rebuilding the grid. So things like electrical infrastructure, U.S. industrials, certain technology plays, I think, in addition to sort of the monetary dynamic that supports them from just repressing the bond market, there's a real fundamental case in terms of not only going to be repressing the bond market, but this industrial policy, this financial repression is going to be at least partially directed into these productive enterprises, a lot of which have very good pricing power, et cetera. So, I think things like industrials and grid-facing investments in the U.S. broadly will do very well over the next several years.
All right, and I'm just going to share this chart. I don't know if it's the exact same one you were talking about, Luke, but it's one that's been making the rounds, which just very much shows here exactly what you're saying, where electrical generation capacity in the US and in the EU has basically been, flat for decades here. And China has just been investing in this like gangbusters. So to your point here, they're over 2 times the US right now. And of course, they've got all the momentum here. And to your point, the AI race is going to be won off of cheap, abundant energy, cheap, abundant electricity, right? I think I heard somewhere that they're adding like a US's worth of electrical generation every year and a half at this point. So, to the extent that we say, look, AI is a national security priority for us, it's a must win. We are going to have to start making the US trajectory here look a lot more like China's on this chart. And that's going to take just a ferocious and phenomenal amount of investment. All right, gentlemen, I'm looking at the time, and I know the audience would like for us to go for 5 or 6 hours here, but I can't ask that of you guys. So I've got a couple questions to ask here as we start to wind down, and then I will also give you guys the chance to say, hey, look, is there anything that's burning on your minds that you'd love to talk about with the other person that I just haven't thought to ask you here? But Darius, go ahead.
Can I do that in reverse order? Because I do have a very
Perfect.
interesting share in response to the electricity
Absolutely.
power generation. To me, and here's why I think Paradigm C is ultimately going to fail, and why we're eventually headed to Paradigm D, which is the print phase of this process. When you go back and you study the 5 largest sort of tax relief programs we've seen in the post-war U.S. economy. There were the 2 Reagan tax cuts, there were the 2 Bush tax cuts, and then the Tax Cuts and Jobs Act of 2017, the Trump tax cuts. all five of them have a atrocious record of setting the US's debt to GDP ratio on a different trajectory. What happened in all five is that you get this sort of transitory boom in growth that lasts for, anywhere between 2 to 3 years, and then ultimately resume back to the previous downtrend. Similar dynamics with the budget balance. You have this increase in the budget balance or decrease in deficits, which ultimately resolves themselves with more deficits over the long term. And so the net result of all those dynamics is the debt to GDP ratio just keeps on rising. And so if you look at the first Reagan tax cut, we started the debt to GDP ratio was 30%. We wound up with a subsequent 10-year mean of 45%. The second Reagan tax cut, the debt to GDP ratio was at 46%. We wind up with a subsequent 10-year mean of 53%. The first Bush tax cut, the debt to GDP ratio was 41%. We wound up with a subsequent 10-year mean of 54%. The second Bush tax cut, the debt to GDP ratio was 45%. We wound up with a subsequent 10-year mean of 62%. And then I don't even want to be too mean to President Trump. I'll just isolate the Trump tax cuts to the subsequent 2 years because obviously we got COVID in 2020. If you look at the debt to GDP ratio in 2017, it was 88%. It averaged 91% over the next 2 years. And this is in the context of creating an economic boom in those 2 years. Mm-hmm. And so the key takeaway is, no matter how they try, whether it be fiscal spending from the Democrats or tax cuts from the Republicans, it's not going to work. And one of the reasons, going back to this power generation discussion, is one of the reasons it's not going to work is because AI, based on what I just saw in that chart, it's probably not going to be what we hope it's going to be in terms of creating these fantastical outcomes instead of a real GDP growth and productivity. It obviously will create more real GDP growth and more productivity than we're currently used to as investors. But if we stay anywhere near that current trajectory, which I don't see anything from a legislative process that says we're going to materially alter the slope, it will go up. Obviously, they're talking deregulation, they're talking energy reform, and they will be for years. But we're never going to get on a path that suggests we're going to grow our way out of these debt dynamics. And so ultimately, you have to assume that at some point there will be an intermission between paradigm C and paradigm D that's going to be very painful. It may involve political volatility in terms of transitioning back to the Democrats, maybe lurching even further left from a socialist perspective. If you think about what's happening in the New York City mayoral race right now, these are all the kinds of things that you should expect in four turnings in terms of the political volatility and the transition from cut to grow to print. And right now with the early phases of growth. So I want investors to be aware that even if you've missed, this upside our clients have captured over the past few months, there's plenty more upside. So don't be too concerned as an investor. Just hop in, figure it out. If you need risk management help, come to me for risk management help. Go to Luke for where we're all headed. I will trust Luke on that more than myself. And then I think you put those two resources together, you're going to do just fine as an investor.
Okay, and I think it's a really important message here because, again, I think people hear your concerns about how this is all going to end up fourth turning wise, right? And they think disaster, and they think kind of Great Depression, right? They think massive market corrections. They think huge deflation in asset prices, and in many ways you're saying kind of exactly the opposite, which is expect asset prices to keep going up here. They're going to have to because that's the natural output of a lot of the policies that are going to. We just know from history are going to be pursued here, by the central planners. So I just, again, I want to really underscore that because I hear it from a lot of people that watch these videos, and I've seen it over the past decade and a half of people have gotten concerned about these same big macro trends that we've been talking about. They get into this bunker mentality. They get out of the markets, or even worse, sometimes they go real short and can get destroyed by what you're talking about here, Darius, when it goes against them. So again, folks, just really take that to heart.
If you want to get into a bunker mentality, get into the bunker about the bond market. The bond market is the problem. That's where you need to get into the bunker. And the reason that we're so bullish structurally on stocks, gold, and Bitcoin is because the bond market is the problem. That's where you want to be out of. There's $10 trillion when you combine advisor managed pie chart asset allocations and target date funds that have an entire generation of baby boomers choking to death on bonds. 10 plus, and then all these other, machinations of here's how to get more bonds in your portfolio, Mr. or Mrs. Baby Boomer. To me, it's a disservice to the investing public to continue for the Wall Street to continue creating these types of quote unquote retirement solutions, because they're putting you in the wrong asset classes where you should in fact be in a bunker hiding away from. The stocks, gold, and Bitcoin is how you get out of the bunker to the problems in the Treasury bond market. Now, you're going to need to risk manage it because it's not going to be a linear straight ride over the next 5 to 10 years. And obviously, fourth turnings tend to end very climactically in a bad way. I'm hoping we avoid that. But ultimately, to me, if there's one key takeaway from anything I said today, it's the problem isn't the stock market, the gold market, or the Bitcoin market. It's the bond market is the problem. And ultimately, how the monetary and fiscal authorities respond to the bond market being the problem is why we're so structurally bullish on those three asset classes, stocks, gold, and Bitcoin.
All right. All right. Very, very well said. The other thing I just want to note too, that Darius says, okay, prepare for the eventuality of President Mamdani at some point in this process.
Well, I've since learned he was born around not in the U.S., so he can't run.
He was born in Uganda, so yeah, he technically can't be
president. That is a clear signal that folks below my age are very interested in potential solutions to all the K-shaped problems that have us on this political volatility cycle to begin with. So maybe it's not Mamdani, but you have to assume that the popularity of folks like AOC, Hakeem Jeffries is going to rise as we progress throughout this Trump administration. And you may see a political backlash lurching in that direction at some point that could cause some volatility in asset prices. So I think you have to expect these outcomes as an investor, because we know growing your way out of it is not going to work. We've seen this in the data.
All right, so Luke, I'm going to come to you for this question. I know Darius has stuff to say about it too, so Darius, you'll get a chance.
I'm shutting up. I've been talking too much.
No, well, we'll go to Luke. We'll go to Luke first. But so you mentioned K-shaped K-shaped economy. I think both of you have said in this discussion earlier that you expect wealth inequality to continue to worsen as we go along here, which makes sense, right? As asset prices continue to go up here, for the reasons you guys have discussed, who benefits? Well, those that own the assets. And asset ownership is highly concentrated, especially financial assets right now. And it's probably only likely to continue from here. So in terms of a K-shaped economy, I've recently put out there on X, you don't have to agree with me, but I think that we may be in danger over time of the K morphing into an I. Think of a lowercase I, where you have wealth concentrated in very few hands, and these people are prospering and they're kind of separate from the rest of society, and everybody else is falling below the line, right? So everybody else is just struggling and having a harder and harder time keeping up. So Luke, if we can, so financial markets are going to do what financial markets are going to do going forward from here as we head into this future that you see. What do you see for society? And how concerned are you for just where society is headed on this dimension of wealth inequality?
Look, there's way. I mean, it can work out really well. It could work out really badly. The tails are very far out, and they're very fat relative to sort of where living memory of pretty much everyone alive, right? That's really sort of an alternative definition of a fourth turning, which is just basically. And I think there are a lot of factors that are making that more difficult, right? There's the debt side that we've talked about a lot. There's the geopolitical side of kind of the classic Thucydides trap, right, of a rising China and an incumbent America. There's the unprecedented pace, and we've had innovation over the last 150 years at an accelerating pace, but it's never been at the pace of what we're seeing with AI. And that has intranational implications, right? I hear a lot of people, and sometimes they're the same people, but I hear a lot of people saying, well, AI is not going to be that big a deal, and China's overproducing. They're producing way too much stuff, and it's creating deflation, and they're taking share from our companies, and they're outcompeting everybody, and it's not fair. Well, then when you dig just a little bit on how China is producing so much with their demographic death spiral, you find out that they are integrating AI into their manufacturing processes via 5G connections between machines. And not only is this impacting their ability to produce goods, but it's their ability to produce weapons and drones and missiles. And you kind of go, what does this imply for crown jewels in America, right? Like there's a way where this goes where if the rest of the world wakes up and decides, you know what? I just want stuff that works, and I don't care about the CCP and its politics, they're going to start buying a lot more BYD vehicles than they do, and a lot more, Xiaomi phones than they do. And Apple's going to lose a lot of share. And there's a world in AI's, benefits are not the birthright of the American and the Western people living in the eye.
Mm-hmm.
I think DeepSeek should have been a warning of like, there's a world where we wake up in 2030 and Chinese companies have taken, significant share around the world from American crown jewels whose corporate profits fall because the Chinese have a different model, and their AI, their willingness to see and build AI and to have the grid to support it means we're unable to compete. And that, so there's a lot of, that is probably the worst case scenario, because now you're, the one wealth generator that we've had, I've been in this business 30 years. I have never been investing in a time when America's tech dominance was not head and shoulders above every other nation in the world, developed, et cetera. And yet in January this year, DeepSeek sent a cruise missile into that belief of everybody. It was, hey, here's something that's better, it's cheaper, and it's open source. Have a good day. And there was like a bunch of rent-seeking models that were planning on AI just being the next Google a la 2005. We're like, and so what does society look like? I think ultimately, I saw something Mike Rowe the other day, the dirty jobs guy, and he's like, look, they told all the blue collar guys learn to code. Well, now the coders are getting displaced. We did a piece recently where it was highlighted. It was a New York Times article feature that we highlighted that 1990, the majority of the biggest employer in the majority of U.S. states was manufacturing. In 2024, the biggest employer in 38 out of 50 states is healthcare. And the biggest job in healthcare is administration. And if there's a sector that is more ripe for AI disruption and unemployment, I don't know there are many other than healthcare administration. Like most of those jobs can be done vastly superiorly. And then you get into other things within healthcare that we are seeing signs of. So we're into this very weird time where you've got a lot of different overlays. And I think it speaks to sort of this volatility side that Darius was talking about, where I don't know. I don't know what society looks like. I can tell you, I don't spend a lot of time worrying about where my kids, get a degree, be good people, because it is moving so fast. It's hard to know. It's almost like when, I remember reading a story, when the Air Force went from prop planes to jets, like they had to get like a whole new crop of pilots, because just basically the world, right, they were used to flying P-51s, and when they went to jet fight, like those guys literally couldn't interface with the world at that speed. You needed a whole new crop of guys. And it's like, I know what I don't know. And with how fast this is happening, I don't know how it's going to go, but I know it's happening fast. I know it's going to be disruptive. I've seen what happens in other cases of disruption. And then I go back to like my one Alamo in the markets, which is, there is, in my opinion, zero chance the United States government or other Western sovereigns are going to nominally default on their debt. They're not going to say, oops, we can't print the money, or we can't make the payment. They're going to print the money. And so I think that's where I kind of fall back to in this uncertainty is, okay, this levels of uncertainty, I think it could be really good for manual labor, things like that. Not, the skilled labor, electricians, welders, et cetera, the trades. And quite frankly, I'll know when we're really, I hear a lot of rah-rah about how we're back, America's back. I'll believe America's fully back and on the right path when I'm reading stories like I was in 2009, 2010 about the Bakken, right? I remember reading, stories about the Bakken shale where truck drivers are making 180, 200, 250 grand. And people are like, whoa, what's going on here? That'll be your sign. When you see your first story in the journal about a welder making 800,000, a million, $1.2 million, like a veteran Wall Street analyst, then we'll know America's on the right track. But until then, we're just playing with our food a bit. It's a lot of, song and fury so far, sound and fury, signifying not quite nothing, but slightly more than nothing. It's not an answer, but I don't have an answer. I can paint you a wide array of pictures around it, but the rate of change, unprecedented. The rate of debt, the level of debt, unprecedented. The growth of debt, unprecedented for peacetime. So many things are unprecedented. I think it just speaks to being unlevered and understanding governments will not default on their debt anomaly. They'll print the money.
Okay. Great. You took it exactly where I wanted to at the end there. Darius, I'm coming to you in just a second. Maybe, Luke, just to ask, given the uncertainty there, but the risk factors beyond just the financial things that people could do, right? Invest for those two key trends that you just mentioned. Any almost more sort of like life advice on entering this kind of potentially chaotic, disruptive, and uncertain of a future?
Yeah, touch grass. Spend time with your kids. It's invest in your mental, because so much of it is right here. Like if you think you can, or if you think you can make it, you think the reality is people that want to adapt will adapt, and the people that don't want to adapt won't adapt. And sadly, like I've seen this, the whole AI thing, I've a playbook for it. I saw it in the Rust Belt when China was AI 1.0. Right, we're going to send the manufacturing factories and jobs to China, and it's going to be this leap forward in profitability, productivity, et cetera. And, ultimately, 1 million people died of drug overdoses between 2010 and 2022. And Deaton and Case did a study. They called it deaths of economic hopelessness. And it's a pattern we've seen play out. We saw it in the 1990s in Russia. We saw it in the 1880s with the Plains Native Americans. You've seen this pattern where a way of life changes dramatically, and the people that want to adjust, and the people that don't, they don't. And so ultimately it comes down to, I think, wanting to adjust, having the confidence, like, listen, I can do whatever, I will adjust to however the environment, and then building that resiliency and that relationship with your kids. Like, listen, whatever comes, like, you are good enough, you are smart enough, you will adjust, you will adapt, you are a winner, you are a fighter, and you go on from there. But I think this world is going to be important for just the mindset and having a family unit, and then they just like go touch grass, go, be out there.
Amazing. Very well said. Yeah, develop resilience, and just don't forget we live in the real world. Just get out there in it and appreciate it. Darius, as a man who is going to a 1-year-old's birthday party today and enjoying the most important things in life, I'll let you have the last word on this topic, and then I'll bring things to a close. I know from past discussions with you, if I took good notes, you do have a concern that, hey, over the next couple of years, asset prices might go up, economic growth, might get juiced from a lot of what's going on here, but the benefits of that might really concentrate in, a few sectors of the economy, in the pockets of a few, people who own the assets and the means of production, and especially as AI potentially is a catalyst for all that. It may at the same time displace a lot of people's, jobs in a way that Luke was alluding to. And we may accelerate our way to kind of this I-shaped economy that I mentioned earlier. So anyways, your closing thoughts here.
Yeah, so a couple things. So thank you for that, and thanks for having us. I could literally sit in a bar with you guys and talk this stuff for days, man. It's awesome.
Same here, brother.
Yeah. So just on this I-shaped economy, the one thing I would say is part of the fourth turning, and I'm actually quite optimistic in terms of where we wind up, because what we found is you never want to short America and our resiliency and our ability to come together to solve big problems. That's essentially what a fourth turning is. It doesn't feel good while you're in it, but ultimately, as my former colleague and one of my mentors knew how, the architect of this framework, he's about as optimistic as anybody. Because
you end up at a first turning, right? The beginning of something new. Yeah.
The rebirth of society and fixing all these problems that we have that are contributing to the K-shape and eventually the I-shape that ultimately caused the ultimate societal destruction and decay that we need to catalyze the big solutions. Right now, we're doing piecemeal tinkering, tinker here, tinker there, Affordable Care Act. Here's some tax cuts for you, rich guy. Here's, we're just tinkering. But the reality is we're not solving the problems. And ultimately, I don't think we're going to solve the problems until the situation gets acute and dire enough from the perspective of enough people, i.e. your lowercase I-shaped economy, for us all to say, just, F it, blow it up. Let's China's the problem, or this is, it'll be a big response to a big problem. And so, that is volatile, but ultimately we're going to wind up in a much better place. In terms of answering how you should be preparing for yourself, preparing for those types of outcomes, I really do think AI is transformative and revolutionary to a lot of what Luke discussed. And, I co-chair the Yale football mentorship program, and, to a person, all these guys are just like, hey, Mr. Dale, how do I get a job on Wall Street? And to a person, I say the same thing to them, which is, hey, why the hell do you want a job on Wall Street?
Don't.
I'm not sure what, there's plenty of other ways to make money, solving society's problems. I don't know that Wall Street is, I wouldn't necessarily say we're ranking high on that list, in my opinion. But one of the things I say to them is, if you're insisting on going to get an investment banking job and this, get out of that mothership as quickly as possible. Mm-hmm. The bigger the company you work for, and this is not just true for those kids, it's true for everybody in working in society in the context of AI. The bigger the company, the more incentivized the company is to reduce headcount as a function of AI. So the sooner you can get to smaller companies where you're having a bigger impact on the top and bottom line, the better, because ultimately you're going to be less insulated from cost savings, is what they're calling it now. Where, Microsoft cost savings, Amazon cost savings. Dario from Anthropic is the only honest person in Silicon Valley right now telling you that they're not cost savings, they're permanent changes in how people's lives function. So you need to save money. You need to start getting out there and forming the relationships that you need in your community, and ultimately understand that, hey, there is a brighter, sunnier day ahead. You don't have to live in fear of all this stuff. We're not trying to scare you. We're not trying to fearmonger you. We're just trying to help you, guide you, your family, and your portfolio through it, because that's the gift that God gave me and Luke, and we want to share that gift with the world. And you too, Adam.
Well, look, thank you. Very well said, both of you. And gentlemen, just thank you for the fire hose of insight and wisdom that you've shared with us today. A huge privilege and honor for me that when you two decided you wanted to have a discussion together, that you were willing to come on this program and have it. And I just want to let you know, huge gratitude for me for that. But the door here is always open. Anytime you guys want to have a discussion like this, one of these co-explorations, I will happily drop everything I'm doing, and we'll do this thing again. Look, gentlemen, I understand this thoughtful money audience very well. I survey them all the time. I know that the preponderance of viewers here are DIY investors, right? They're folks that are coming online to self-educate, to then make more informed decisions in their own investment decisions. You guys give them lots of great info when you come here on this program, but more importantly, you guys run services that are excellent for, provide excellent insights, research, et cetera, for DIY investors. So Luke, let's start with you. For folks that would like to follow you in your work in between your appearance now and the next time on this channel, but more importantly, you might want to learn more about your services and how that can benefit them as investors. Where should they go?
Sure. So for more information about our institutional mass market research offerings, go to FFTT-LLC.com, and you can also follow me on X at Luke Gromen, LUKEGROMEN, and thank you very much for the plug, Adam.
All right. Well, look, it's not a plug. It's literally just hopefully letting people know one of the most valuable services out there. Darius, same question to you. Where should folks go?
100%. So definitely go to Luke's site first, because I think you do tremendous. You do. I really do mean that. I mean, I don't have. Once you become a dad, you realize like your day just shrinks. You just don't have as much time to. If you're doing dad right, you don't have as much time to consume content and research. And I find your feed and all the stuff that I hear from you is up there with anybody, man, across global Wall Street, in my opinion. So. Huge fan of yours. Come check out us at 42macro.com. I think we do a pretty good job on the fundamental stuff, but I think where we really shine for our clients is keeping them on the right side of market risk perpetually. I cut my teeth developing and designing institutional risk management systems for buy-side investors. And so, I left that life and said, okay, I think I can do this for everyday ordinary investors on Main Street to make sure that they get the best of Wall Street too. And that's why 42 Macro exists. And we've, knock on wood, and Lord willing, we'll continue to do a phenomenal job for our clients in the years to come. So 42macro.com is our website. Check us out. We appreciate that. And I'm on Twitter, Darius Dale 42, Darius Dale 42. Appreciate everybody.
Fantastic. All right. So gentlemen, when I edit this, I will put up your handles and your websites there on the screen so folks know exactly where to go. Folks, the links will be in the description below this video as well. Look, guys, you are just consummate professionals, but also just really good men. And I know that's come across for folks in this discussion here. So thanks for just leaving it all in the field the way that both of you guys do. Folks watching, please let Darius and Luke know your appreciation for this and your hope that at some point that they might want to do this again and come back on this channel. To show that, please do me a favor and hit that like button and then click the subscribe button below. And as I mentioned, if you're a DIY investor, definitely go look very intently at both Luke's and Darius's solutions. If you're somebody who ideally would like to kind of recruit the help of a financial quarterback to help you do this so that you don't, I know there are people who don't aspire to be long-term DIY investors. They want to outsource that to a professional. Then consider scheduling a free consultation with one of the professional financial advisory firms that Thoughtful Money endorses. These are the firms you see with me on this channel week after week. To set one of those up, just fill out the short form at thoughtfulmoney.com. And as a reminder, these consultations are totally free. There's no commitment to work with these firms. It's just a free service they offer to be as helpful as possible to as many people as possible. All right, gentlemen, look, it's just been a thrill. What a wonderful way to spend an hour and a half. Like I said, if you guys ever want to do this again, I'd love to have you here. But most importantly, just thanks for doing what you do. And thanks for being good friends of the Thoughtful Money program. And most importantly, just thanks for being good friends of mine.
Amen, Adam. And thank you for everything you're doing for society, brother. I really, really am grateful to have come across you, have met you, have spent some time with you in person, man. You're one of my favorite people, dude. You are, your ethos and how you treat people, you treat the world, and what you're trying to build for society. Mwah. So appreciate you, Adam. Thank you for having me.
I'm blushing. Thank you, buddy.
Likewise, absolutely. Seconded.
Yeah, now you had to say something really nice because Darius.
And I couldn't say it as eloquently, so I'm like, you know what? I'm
still on. I'm still recording.
Yeah. All right. Well, look, we'll wrap up this Mutual Appreciation Society, but it has just been wonderful. Gentlemen, look forward to seeing you again soon. Everybody else, thanks so much for watching.